Axion Opportunity Fund is proud to support entrepreneurs through access to capital and educational opportunities like this webinar. And we are very grateful to our partners at Fifth Third Bank for sharing our commitment to small business. Before we dive into our discussion, I'm very pleased to introduce Robert Brinkley from Fifth Third Bank, who will share a bit about the bank's commitment to the community. Thanks for being here with us, Robert.
Thanks for having me. Good afternoon, everyone. My name is Robert Brinkley, and I am CRA Line of Business Development Manager at Fifth Third Bank. Thank you so much for joining us for today's webinar, The Beginner's Guide to Angel Investors and Venture Capitalists. This is our fourth webinar of 2023 in partnership with the Axion Opportunity Fund. Axion Opportunity Fund and Fifth Third Bank share a common goal, and that's the pursuit of helping entrepreneurs overcome barriers to achieving business growth and scale. Whether you're doing that as a startup or longtime entrepreneurial veteran, our team at Fifth Third and our resources are available to you every step of the way. Please visit our Business Resource Center at 553.com and let us help you meet your financial goals and assist you with smart financial solutions for both your personal and business needs. Thank you again so much for your time today, everyone. Back to you, Brittany.
Thanks so much, Robert. All right, so I am so thrilled to introduce our extremely dynamic presenters and experts today. First, we have Deanna Hamilton. A serial entrepreneur and accredited investor, Deanna Hamilton is founder and CEO of Circle One Inc. After the successful launch of her award-winning consumer product marketing and multi-format printing company, which saw a historic acquisition and exit in 2012. Deanna's passion for the art of the deal influenced her to reorganize Circle One Inc. as a holding company, establishing 3 subsidiaries, Circle One Associates, Investments and Development, which hold her diversified business portfolio in consulting, real estate development, health and beauty, sports nutrition and sports equipment, and medical apparel. With a wealth of experience from Fortune 1000 companies like Stellantis Automobiles, General Electric, and Coca-Cola, Deanna boasts an impressive academic background with a dual master's in finance and business management. She also holds influential positions on several boards, such as the Fearless Foundation and Silence the Shame Foundation. Her exemplary contributions to business and community service have earned her numerous accolades, including awards from the National Black MBA Association and Diversity Magazine Top 50 Under 50 Corporate Executives. Hi, Deanna.
Hi, Brittany. How are you?
Good. So great to have you here today.
Thank you for having me.
Wonderful. And next, we have Sam Sugarman. Sam is an associate at Fearless Fund, focusing on investment due diligence, supporting portfolio companies, and co-managing Fearless Fund's fundraising efforts. Sam spent 2 years in investment banking across healthcare and restructuring sectors, as well as 2 years in private equity fund and co-investing at Hamilton Lane. Prior to these experiences, Sam completed internships in venture capital, investment banking at Fortune 500 companies and startup technology companies. Sam attended Brandeis University and majored in economics and psychology. Hi, Sam.
Hello, thank you for having me.
Wonderful. So glad both of you are here. All right, so we've got so much to cover today, so I am just going to go ahead and jump into it. And Sam, I'd love to start with you for this question. Angel investors and venture capitalists are both types of equity investors. What does equity investment mean, and how does it work?
Sure. So with the types of businesses we work with between the Fearless Fund and the Fearless Foundation, there are typically 3 types of ways that we see companies that are funded. 1 is through grants, 2 is through debt financing, and then 3 is through equity financing, which comes either from an angel investor, a venture capitalist, or another strategic investor. And so just breaking down the 3, with grant funding, you're being awarded a grant, you're not giving up any equity, and there's kind of no caveat there. With debt, there's kind of a mix. So there are some circumstances where you're not giving up any equity and you're given a loan and you're told you have to pay that loan back plus interest, but you're never giving up any part of your company. And then there are convertible loans, also known as convertible debt, where you are giving up part of your company and the debt provider has the option to either collect the loan that they gave you plus interest, or they can convert it and take equity ownership. And then lastly, with equity investing, someone is investing a certain amount of capital and in exchange taking a certain percentage ownership of your business. And so with angel investors, you typically see them come in at the earliest stage, often writing checks anywhere from 10K to 100K when you're really just starting out with a person and an idea. Venture capitalists typically come in later, writing checks of at least 300K to 500K, oftentimes a few million, in exchange for a larger portion of your company at a later date.
Thank you so much for that overview. It's super helpful to know, especially the different stages that as business owners, we might be looking for angel investors or venture capitalists. Okay, moving on to our next question. And Deanna, I'd love to start with you for this one. Many small business owners here today might be wondering, is my business even ready to pitch to investors? Could you provide us with a checklist or specific milestones that indicate that a business is right for equity investment?
Sure. I actually take an 8-pronged approach when I'm looking at evaluating organizations that present themselves to me. And one of the things that I really tell them is they really need to make sure that there's market validation in their product. I am looking to see if they have a demonstrated demand for the product or service that they're providing in the marketplace. Also, the financial stability of the organization. As an investor, I'm going to scrutinize those financials to ensure that there is no risk involved in investing in that business. So they need to make sure that they're financially stable. Is the business scalable? Do we have the opportunity as an investor to see a potential significant growth and a clear path to achieving that growth with that business? Do they have a solid customer base? Is there any intellectual property or assets, trademarks, copyrights, patents? Those are definitely for an investor tangible things that we really look for to know that that business really has a unique proposition in the marketplace. Do you have a solid business plan? Are you updating that business plan? Are you looking at that business plan annually? Is it a clear path for growth in that business plan? Do you have a strong team? Have you assembled capable and experienced team members to help you scale and grow the business? And do you have a clear exit strategy? Those are 8 things that I truly, truly look for when I'm looking at investing in businesses and investment opportunities, especially equity investments. And there are a plethora of others, but I think those are the 8 priorities that I would want any entrepreneur to truly, truly hone in on and understand.
Thank you so much for that, Deanna. That's great to have that 8-pronged approach, because you can really go step by step and see, is my business fulfilling these different areas? Sam, I would love to ask you the same question. So when small business owners are wondering, is my business even ready to pitch to investors? Could you provide us with some things that you might be looking for so they can determine if they're ready?
Absolutely. And I think Deanna did a great job of covering many of the things that we would cover. I'll give some additional context as it relates to venture capital investments, because I think there are a few important things to distinguish. So number one, with an angel investor, they're typically investing their own capital, whereas venture capital investors manage a fund of other institutions' capital. So some of our investors are Bank of America, JP Morgan, MasterCard, among others. And when they invest in the fund, they're expecting a certain return from the overall portfolio. Thing number two is, when doing venture capital investing, what we typically see is, say we make 30 investments, oftentimes 60% of those companies end up failing. So call those 18. About 9 of those companies, or 30%, end up doing all right, kind of delivering a 1 to 2x. And so what we're relying on as venture capital investors is 1 or 2 investments to deliver such a good return that it returns the entire fund. So if we have, again, using this example, a $30 million fund and 30 companies, and we write $1 million check, what we want to see is there's an opportunity to return a 30x. So if we invest at a $10 million valuation, we want to think that there's an obtainable, a real opportunity, a tangible opportunity to exit at a $300 million valuation, which is a 30x return from the original valuation we're investing in. And so a lot of the overlap, like Deanna said, there are 4 things that we look for primarily from the Fearless Fund side. Number 1 is team. Do the individuals have the relevant backgrounds? Do they have complementary experience? Number 2 is the market. Is, there a large market opportunity, a large immediately addressable market? Is there a lot of competition in the space? Number 3 is traction. So typically when we look at consumer businesses, we like to see actual revenue. Whereas with technology, like a marketplace, there are some metrics that can be used in place of revenue, like daily active users, monthly active users. If it's a platform with bookings, seeing booking numbers increase quarter over quarter. And then last is product. So just the quality of the product, and then the product roadmap. So the developments that you'll be, making to enhance the product over the next 6 to 12 months.
Thank you so much for that, Sam. That's also very helpful to look at it from both sides, and just to have kind of an insider's view from Deanna and Sam, from both of your sides, of what investors are looking at when they're looking at our businesses. Okay, so Deanna, I think this question is going to be really relatable to a lot of folks. Finding investors can feel like searching for a needle in a haystack. What kind of resources or networks can small businesses tap into to connect with potential angel investors or venture capitalists? And are there online platforms or local groups that you might recommend?
Absolutely. For today's entrepreneur, there are a plethora of resources, and it actually warms my heart to see, because in 2006, I did not have these opportunities. And so there are incubators and accelerators that exist today that you can simply find on social media platforms. One of my favorites is New Voices Foundation, which is owned by Richelieu Dennis, who owns Essence Magazine. He does a really good job of startup incubator and accelerator programs that I absolutely love. And they provide mentorship and resources. Many of our banking partners also have accelerators you can tap into. I'm sure Fifth Third Bank has one, and others. If you look around the landscape, there are a lot of pitch competitions. You take advantage of those. Oftentimes with the pitch competition, the judges are investors, or they're sitting in capital organizations that could potentially do some institutional investing. There are online platforms that I absolutely love, and Start Engine by far is my favorite, especially for crowdfunding. I look at Start Engine every morning as an investor, and I invested in Fanbase, and happy to see that Isaac just hit 10 million on Fanbase. So I really like Start Engine and crowdfunding options. But pitch competitions, Afrotech has one, National Black MBA Association has one. There are a plethora of places today that you can find access to investor resources. There's even a venture capital association that a lot of people probably are not aware of. And then Fearless Fund Summit. There are summits very similar to Fearless Fund, where you have access to resources, education, as well as financing options and funding options. So there are plenty of places today that you can find funding resources, from angel investors to VC options, as well as grant options in the marketplace. And I am happy to see that.
That is so wonderful too, especially you sharing how much things have grown since, like you said, when you were looking for this in 2006, there are so many more opportunities and options to get out there. And I know you mentioned pitch competition. I'm monitoring the chat, and I just heard someone mention that they're here preparing for their pitch competition. So definitely, keep an eye out for those. Sam, I would love to ask you the same question when it comes to searching for investors. what kind of resources or networks can small businesses tap into to connect with potential investors or venture capitalists? And are there any platforms or groups you recommend?
Yes. So I'll make sure not to repeat any names, although I agree with every single one of those suggestions. Especially New Voices, love their platform and they overlap with us quite a bit. So we're very supportive of everything they're doing on both the fund and foundation side. A few avenues I would add. Number one are kind of local universities. A lot of them have entrepreneurship or resource centers. And even if they're not the right fit to help you, they can be very helpful in making relevant introductions. Another thing you'll find on top of that is local groups that are focused on entrepreneurship generally. So I grew up in the Baltimore area. One group that's in Baltimore is called Upsurge, and they're specifically focused on growing the entrepreneurial community within the Baltimore ecosystem. And so they'll always take a call with a new entrepreneur and they'll make a new introduction, if you take the time to reach out to them. So I think it's a lot of groups like that. And then lastly, I would add a lot of accelerators that you may hear of. While they are very competitive to get into, for example, Techstars, when companies are applying, they're always willing to take intro calls with companies to explain, what an accelerator is, why them, what's the benefit. And I think if you go and take a call with them and say, I'd love to learn more about this avenue, but if it's not the right fit, who would you recommend I speak with? There are a lot of opportunities there as well.
Ooh, I love that. I love the idea of first going to your local universities and seeing what connections, and yes, also taking the opportunity to just say this might not be the right fit, but not looking at that as like a door closed, but really an opportunity for intro to someone else. So that's so wonderful. Okay, so moving on, the term due diligence, it comes up in a lot of investment discussions, and it sounds quite formal and a little bit intimidating. Can you break down what the due diligence process involves for a small business owner, and what are investors looking at during this stage? And I'd love to kick this to Sam.
Yes, absolutely. So I think that it really does depend on the firm, and I can speak from the venture capital perspective. I know for angel investors, individuals are looking for a lot of different things and they invest in earlier stages most frequently. So I can't speak to that side of things. But from the venture capital perspective, Fearless has a 3-stage investment process. So stage one, what we're really trying to create is a checklist and say, do you meet the basic criteria to be considered for a venture capital investment? And so again, that means if we invest $1 million, we have a $30 million fund, do we see a realistic opportunity for you to create a 30x return for us? And so the 4 criteria, again, that we're focused on are team, market, traction, and product. So what we do when we meet with a company for the first time is we grade each of those categories 1 to 4, and we want to see an overall score of 12 out of 16 to move you forward to the next round. So after that basic screening stage, we take a second stage, which loops in kind of the sector experts on our team. And we talk more about things like unit economics, go-to-market strategy. So if you're a consumer product company and you're going direct to consumer right now, oftentimes venture capital firms will need you to add some sort of retail or maybe food service component like hotels or restaurants in order to hit venture scale. So talking about what you're open to, what your plan is there, and then product development. So how are you going to build? How can you upsell your existing customers? Things like that. And then lastly, in our last meeting, what we think is really important is not only, are we giving you capital, what are you going to do with it? But beyond that, how can Fearless Fund be helpful? Because if we have a lot of relevant connections or expertise in the area that you're building, that creates a lot of, of an advantage for us, because if you come with us specifically, we can grow together. Whereas we tend not to invest in sectors where we don't have a lot of expertise. So if you came to us with a gaming company, we probably wouldn't take a deep look at you because we wouldn't be able to add value beyond providing the capital.
That makes a lot of sense. And it's really good to kind of understand that, it's it's really a partnership in that you want to make sure that also your investor is adding value to you as well. And so I really liked that gaming analogy that you brought up. That was super helpful. Okay, so when we think about negotiating in terms of equity investments, it can seem like, a high stakes game, especially when you're brand new to it. Could you share some strategies or common pitfalls for small business owners to watch out for during negotiations? Sam, I'd love to start with you.
Sure. So I think number one, which is most important, is having an understanding of what market terms are around how much equity people or companies typically give up when they're raising a round. So, pre-seed, seed, Series A, in each of those rounds, you'll typically see a business owner give up anywhere in between 10 to 30% of their company in a given round. The sweet spot is normally around 15 to 20%. So if you go to a VC investor and say, I have a limited amount of revenue, I have a product, and I want you to invest $1 million, but I'm only giving up 5% of my company, that might be a deal breaker for a VC. On the flip side, if you're saying, I'll give you 30% of my company and not giving yourself enough credit, that might be something that you regret later. And then I think there are a few other smaller components to think about, which is oftentimes when VCs invest, at least, they'll ask for a board seat. They'll ask for pro rata rights, which means if I'm coming in and buying 10% of your company and you raise a round later in the future, I want to be able to invest more and maintain my 10% ownership. And so making sure that, you have those terms set so that I'm not taking too much equity or that I'm the right partner and I don't have any incentives that misalign with what you're doing. And then the other term that's very standard is called an MFN, or most favored nations, which means if I invest at, call it a $10 million valuation, and then Deanna comes in and invests at a $5 million valuation, I have the ability to convert my deal to her deal because it's better, and so you're fair to everyone. So that clause is important because if you raise a little bit of capital and then you find out that you really need more and you offer someone a sweet deal, everyone will end up getting that sweet deal. So those are a few things to consider.
Oh yeah, that is super helpful. And just for I wanted to ask, because in the beginning you said pre-seed, seed, and whatnot, and I don't want to get us too off course, but can you explain really quickly what that means for folks who are just, brand new and just kind of considering this stage? Like, what does pre-seed, seed, what does that mean?
Sure. And I just saw the question in the chat about NFN. It's M as in Moo, FN, most favored nations. So I guess to break down pre-seed, seed, and Series A pre-seed round is typically the first institutional round that a company will raise. So maybe you've raised anywhere from, a few $1,000s up to $100,000 from friends and family, but you're really going for a little bit more and you want to raise, 300, 500K plus in a pre-seed round. So at this point, you have a team, you're either creating a product or you have, a product available, kind of a base case product. And your intention is that you're going to take this funding, finalize your product, and go to market or grow your sales. At the seed round, you're typically already generating revenue. So if you're a CPG company or consumer packaged goods, you're generally, generating at least a few $100,000 in revenue, oftentimes a few million. If you're a tech company, you're normally doing about kind of anywhere between 20K and 100K a month when you're raising a seed round. So you're a little bit more established. And then to raise a Series A, you're kind of thinking an evaluation range of 30 million plus at least, oftentimes 50 million, 75 million or more. We like to see revenue of at least kind of 3 million to 5 million, and you're much more established. And so there's very limited operational risk with your company. What our bet is that you'll be able to take this capital, grow really quickly, and that you'll be able to deliver an attractive exit. But all of the basic kind of operational concerns that you'd have at an early stage have already been addressed.
Got it. Thank you. That's super helpful. Just as we are kind of orienting ourselves to, which advice that we're going to take for where our business is at in the different stages. So Deanna, I would love to ask you the same question. Negotiating deal terms can seem like a very high stakes game, especially when you're new to it. Could you share some of your strategies or common pitfalls you've seen that small business owners should watch out for during negotiation times?
Yes, Sam did an amazing job, and I'm going to be a little bit more practical and yield to the human side of us when we're in this conversation. And one of the things that I would say is we must go into the negotiation understanding the needs of the other side of the table. And oftentimes that does not happen. We always go in with what we need and not creating a win-win solution in the relationship. And so I think that is a common pitfall that happens during negotiation. Another one is sometimes we go in very overconfident. And I get that confidence is required in our business, but that can also lead to very unrealistic demands and the inability to actually compromise in the deal. So be very careful with that emotion. And also, speaking of emotion, ensuring that we're calm and rational in the negotiation and we're not making emotional decisions. But I would say probably it's two powerful ones that I see often. And one of those is not seeking legal and financial advice before you start negotiating. I see it way too often. And one of the things I always say, an ounce of prevention is worth a pound of cure. That is an old wise tale, but it is a very true statement. Our paperwork, our legal paperwork in particular, and our agreements must be reviewed by lawyers. I always say business is not personal. And when money is involved, it is really not personal. And so making sure we have our legal agreements intact, and so we have no issues down the road. And probably the most impactful and a common pitfall I see is ignoring the power of no. Every deal is not the best deal, and we can't be too desperate in the negotiation to not be able to walk away. And so those last two are probably the most common pitfalls that I see, and that I would encourage entrepreneurs to really understand and lean into.
So incredibly helpful as a reminder, Deanna, that yes, you can say no, and yes, you just want to make sure you're making the right decision for your business. I love that reminder because, like you said, it really does speak to the more human side of things, especially when we're working in our business. We know, we have a deep connection to it, and just being able to kind of take ourselves out and take care of ourselves through those negotiating processes is really important as well. Lots of love in the chat as well for this. And I see folks with the questions. I promise I'm keeping track of our questions because we're going to be coming up on our Q&A in just a bit here. And just a reminder, we will be sending out a recording and the resources to your email. So you don't have to worry about frantically getting everything down. We'll make sure you get it. Okay, so continuing on, Deanna, I have another question for you. If we realize we are not quite ready for venture capital or angel investment at this time, what are some steps we can take to prepare our business for future funding opportunities? And how can we ensure we're on the right track?
I would say making sure that you have a strong business plan. Sometimes we start our businesses out of passion and we take having a business plan for granted, but it is really a roadmap document that allows you to be clear and concise and build a compelling case for your business and the growth potential of the business. One of the things that I truly, truly encourage is your operational or organizational structure. Accurate financials, having an operational efficiency model that allows the business to run smoothly the right tools in the operational function of the business. What investors want to see is that your capital or their capital will be used effectively and not wasted on inefficiencies. And it's the same thing on organizational development, building a strong team. We want to make sure that the right people are in place and have the capabilities and the dedication to actually do the work and lead the organization into its growth. Another is understanding the valuation of your business when you're getting ready for investment. Understanding what your business is truly worth, so that you can be in a good place for negotiation with potential investors. Strong customer base. That is very important as well to an investor, showcasing that customers are satisfied with the product and the demand of the product or service in the marketplace. Market awareness, being prepared to adapt or change to the market trends. Do you have a plan for that or a strategy for that? The ability to demonstrate that you're actually scalable. Do you have a clear path forward for growth within your organization that will not create incremental cost structure or increasing cost in scaling that business? Do you have a demonstrated track record of success, and do you have that documented, showing that you have achieved tangible results? And I am a big proponent of intellectual property. Vast majority of my investments are that. And can your product have a patent or trademark associated with it? That is a major win when you're talking to investors. And also an exit strategy. There are so many things that when you're getting ready to look at funding that need to happen within your business, but those are just some of the points that I think are very fundamental before you go before an investor, whether it's an angel investor or a VC fund. Again, legal and financial advisors are a win for you. If you do not have a board of advisors, you need to put one together. They don't have to be a paid board of advisors, but having an accountant and an attorney on your board of advisors is paramount to your success. They help you tremendously in building your machine, as I call it. They help you maintain that transparency that you need in building the business, as well as help you with continual improvement in the business.
That is so helpful. I was actually just jotting down, you said, building your machine. And I really love what you said about building your board of advisors. This can sound a little bit, overwhelming, but when you get down to it, making sure you have your accountant, making sure you have an attorney, you have the right people in your corner, make sure your business is protected, and help you make those well-informed decisions so helpful. All right. So I'm gonna, pause here. I see so many great questions coming in the chat. Here are some really wonderful resources for your business. Like I said, we're gonna make sure you guys get everything you need. I'm also gonna drop a link in the chat just shortly, and that is gonna be for our one-on-one free business coaching. In the spirit of Deanna mentioning, building your machine and making sure you have the right people in your corner. If you have a very specific question and maybe doesn't get answered today, we have free expert business coaches here at AOF who are here and ready to support you if you have those specific questions. So I'll drop that link in the chat. So that way, if you're like, hey, I really want someone to work in tandem with me to figure this out, you have that. So, sorry, we are still in questions. All right, so we're going to go ahead and start our live Q&A. And this first one is for Deanna, because we've mentioned an exit strategy a couple of times. Can you tell us what is an exit strategy?
Sure. An exit strategy is, I always tell people, you have to know when you start your business, you have to begin it with the end in mind in order to really build a viable and sustainable business. And what that means is, in building that business and your exit strategy, would you like to sell it? Would you like to sustain it over an extended period of time? Would you like it to have an exit strategy of initial public offering? What what is the end goal of that business for you? And then you build that strategy out so that you build your course of action and your plan of action to get to the end goal. Oftentimes, entrepreneurs build businesses out of passion. I can think about in 2006, I built my business out of anger, but that's a different conversation. And you don't know what you want the end goal to be. So it's like putting a hamster on a wheel and you're just running this race, but you really have no clear, definitive direction of where you're going. And then the business is building and you're building capacity and you're scaling. You want to make sure that you are working towards a goal, and that end goal, whatever that is for you. Is it to sustain it, create a viable and sustainable business? Is it to build it for IPO, for an exit, or is it to build it to be sold? And so that is what an exit strategy is and can be comprised of. But it is very, very important that you build your business with the end goal in mind. That allows you to build a clear, definitive business. And so you can take the necessary steps to move forward in building that viable business.
That is really helpful in just orienting ourselves when we start our business. What is our end goal? Like, what do we want at the end of this? So helpful. Thank you for that. Okay, our next question. I'm going to kick this one to Sam because we talked a lot about, or you mentioned a lot about looking at the team. This question is from someone who is asking, do you need a team? They are a small service-based business, and they're just trying to focus on getting some tech and some infrastructure in place before they get their team. So they're just wondering, do they need a team to be considered for equity investment?
So from a venture capital perspective, a lot of the deals that we invest in, a company will come to us at a pre-seed or a seed stage, so still relatively early on in their journey. And what we find is that a lot of the business models pivot, the pricing models change, the markets you go after are adjusted. And so ultimately, what's most important from our side is trusting the team and that they have the understanding of their market today, that they're adaptable, they can make the right adjustments, and that they're in it for the long haul. Because we invest in companies anywhere between 5 and 10 years and expect a pretty substantial return when we do invest. So it's a lot of expectations, a lot to manage, and things change all the time. So from our perspective, there does need to be a team in mind that we need to trust with our capital.
Yeah.
Got it. So yes, needing a team because things are changing so frequently. So this might be a great opportunity to go look back at some of those tips and tricks to kind of, prepare and beef your business up before you go to the equity investment side of things. There is a lot of questions when we were talking about, pitch competitions or other things like that. And this question is, where are some places what are some tips or tricks or resources we can look to make sure we create a good pitch? Basically, like, where do I start? Deanna, I'd love to kick this question to you.
I would say the first thing is you must be able to articulate what your product or service is solving for in the marketplace. When you're thinking about a pitch competition, that I think is probably one of the most important pivotal moments in the pitch competition, to say what you're solving for. The second would be what the market opportunity is. And then what the market positioning is for that product or service. I've sat through many, many pitch competitions. And I would say those first three are very pivotal, as well as your competition. Do you know who they are? Where do you fit into that competitive analysis? What is your marketing and sales strategy? What are your financial projections? But probably the most important three, I would say, is what is your product solving for? What is the market opportunity for the product? And is it sustainable, and can it expand itself in the marketplace? And what is that marketing position? What is that plan to capture market share and ensure it's sustainable?
That is really, really helpful. And we are going to be sharing a resource tomorrow as well. If you're like, okay, I love that information. I feel like I just need a step-by-step process. I'm going to drop it in the chat. There is an interactive course, a free interactive course, learning to pitch your business from the ground up, so that you can take all this great information you heard today and really focus it in on building a pitch for your business. Okay, so this question I think has come up a couple of times when we talk about equity investment. How do I know how much money to ask for and how much equity to give up? I will kick this question to Sam.
Sure. So I think, sorry to start off this way, but I think it definitely depends on the type of business that you're operating. So if you're operating a a business that has a technology product, odds are it'll take a little bit of time before you become profitable. So you'll need to raise subsequent rounds. And so if you're raising a pre-seed round and you kind of have a product and you're going to go out to market, and you know that you need to get to $1 million in revenue before you raise your next round, and it'll take you 18 months to do that, you probably want to raise enough capital so that you're able to continue operating your business anywhere from 18 to 24 months. So that's one way to think about it. If you're running a consumer business that's already profitable, and maybe you're raising additional capital so that you can scale more quickly, I think it's thinking about what are those key initiatives? Because if you're already profitable, you want to have enough cash to grow quickly, but you don't want to sell too much of your equity. And then when you're thinking about valuation around the round, I would just keep in mind that the majority of groups that raise fundraising rounds sell anywhere between 10% and 30% equity ownership, with the sweet spot being 15 to 20%. So think about the amount that you need to raise. Think about that kind of framework in mind about what's typical for entrepreneurs to give up to raise their fundraising round. And then I would also kind of leverage public resources that can help you show, hey, X company that does a similar thing to what you did raised X amount of funding. And so you can kind of leverage that. So when an investor asks you, why are you raising this much? You can say, I'm working on initiative A, initiative B. I saw a competitor of mine raised a similar amount. And this is the valuation range because this is how much equity I'm comfortable giving up. And then from there, you have a starting point for a good discussion.
That is super helpful. And I love how the conversation is really structured so that you're really prepared to answer all of those questions, why your numbers are at where they're at, and giving the investor a very clear view of where you're going. This question is we've had a couple of questions about this. People are asking, if you have a service-based business and not a product-based business, can you still look for venture capital or angel investors? And I will kick that question to Deanna.
I would say yes, you can. It is extremely tough, however. If I think about it, I bootstrapped my business, but because it was service-based initially, and it is really, really tough. But today you have a lot of options. We didn't talk a lot about grants, but there are granting options that are coming from many of our existing funds that would do well for service-based businesses. Angel investors will do that based on your book of business. While it may not be a purchase order, but your receivables could also be something that could be leveraged. Your contract receivables and a service-based business could be leveraged around angel investing. VC investing, I would say not so much, and Sam can definitely chime in on that. That is really, really tough. Your contract receivables would have to be relatively high in order for that to be a topic of conversation on a service-based business. But I would say definitely lean into grants, as well as angel investors, as long as you have contract receivables that are what you're looking for and or exceed 2 to 3 times X of what you're trying to raise, then you likely can get some angel investment.
Yes, that is super helpful. And I love that you mentioned the different options. I feel like, you know, everyone who's here in the audience representing their business, just know that there are so many different options that you can go to. We will drop a resource link so that you have some places to start looking if you're wondering, you know, where can I start with grants or other types of things like that and other services. We'll definitely drop some of those in the chat and in the follow-up email. But it is just really good to have a clear overview of all the different options that are available. This next question, I would love to actually, I'll start with Sam, and then I'd love to also ask it to Deanna as well. From your perspective, what are the most important questions to have in mind when pitching to an investor? Sam, I'll start with you.
Sure. So I would say, if I'm going to put kind of the three most important questions, number one, this is a two-parter, so sorry for cheating. You know, what is the problem? How big is it? And who's addressing it today? I think it's number one. Number two is, why is your solution sustainable enough that it will not only, you know, stay in market, but beat out competitors? And then number three is, like I mentioned earlier, a lot of things are going to change, business models, markets. So why should I trust you as the team or the individual to build this business instead of giving my capital to someone else and having them do the same thing?
Yes, those are very helpful. It gives like a very clear view of what you should be thinking about and how you should be pitching. I love that. Deanna, I would love to ask you the same question. What are the most important questions from your perspective to have in mind when pitching to investors?
I totally agree with Sam. The others that I would say is, you know, how big is the market opportunity? And you heard me say this before. How big is the market opportunity? I'm sorry, am I asking this from my lens? I'm thinking from my lens.
Yes, no, great question. Yes, what are the most important questions from your perspective to have in mind when pitching to investors?
Yes, okay,
Yes.
I want to make sure. Yeah, how big is the market opportunity? And how many competitors are in that market that will impede you from taking up market share from a growth perspective is the one question. And again, what are you solving for? What is the problem that you're solving in the marketplace? Oftentimes, entrepreneurs start businesses purely out of passion. That may not necessarily be solving for something in the marketplace, and or the marketplace is beyond overcrowded with that particular product or service. And so I always ask, what are you solving for in the marketplace? Does the marketplace need what you are actually selling? And you have to be able to really, really answer that question and hone in on it. But the others that Sam mentioned are key points as well.
Yes, I think all of those questions just really help. Especially I think about how I prepare to, you know, give a presentation or anything, knowing what the audience I'm speaking to is looking for. It can really help you make a very impactful presentation or pitch in this aspect of things. All right, we have a couple more minutes, so we'll cover a couple of more questions, but I know some folks were joining a little bit later, so just want to remind everyone to keep an eye out in their inbox tomorrow for the recording of this webinar, along with some of the resources that we mentioned today. We'll make sure to get those to you. And also, I see that we have some very specific questions about, you know, your specific business in the chat. And so I really want to encourage you to maybe seek out our free coaches, a free session with our business coaches. I'll drop that link in the chat as well, just so you have someone you can spend a little more time with to discuss these kinds of questions. Okay, so one of our last questions is, what are your thoughts on bootstrapping? Would this help us get ahead of potential competitors? And Deanna, I'd love to kick this to you because I know you mentioned you bootstrapped your own business.
Bootstrapping is a necessity. Um, I I would not, if you don't have to, then that is great. That's less stress on you as an entrepreneur. But when I started my business in 2006, that was my only option. As a minority woman in an industry that was littered with men, it was very difficult to get funding. And so I used my own personal savings to start that business and build that business and scale it. And I knew that I could not fail. And so I did what was necessary. So I would say, if today you have a lot of other options, you have granting programs, you have accelerators and incubators that assist you with finding financial options. So I would say lean into those first. But if bootstrapping is all that you have to do, then if you want the business to begin and truly build it to be sustainable, then we oftentimes will do what we have to do. But do not do it from credit cards or things like that. If it's not from your savings, try to find friends and family first to assist you with building the business from a bootstrapping stage. But I don't necessarily recommend it. If you can find pitch competitions and granting programs to assist you, I would highly recommend you go that route, because it is a very stressful, and I do mean stressful, route to go.
Thank you so much for that. And yeah, that is super helpful. Of course, if you don't have to do it, I think it's extremely inspirational that you were like, hey, it doesn't exist, I have to do it myself. And we had a quick question in the chat of what is bootstrapping. So Deanna, if you wouldn't mind just briefly mentioning what bootstrapping is.
Oh, sure. Bootstrapping is essentially using your own money to and a single resource to build a business. And I bootstrapped my business with $60,000 of my own money from my personal savings. I actually saved up all of my bonuses in 1 year and used that to start the business. And so that can be risky depending on if you're not working or if you're still working. And in my business, in bootstrapping, I stayed in my full-time job while starting my business for 2 years before I stepped away. So when I say stressful, you're working a 9 to 5, and then you're coming home working your business from 5 to midnight. And so it can be really stressful. So why I say, if you have other options, it is better than using your personal savings, because once you start digging into your personal savings, you must succeed. So that is what bootstrapping is when you talk about small business.
Yes, thank you so much for sharing that. And extremely inspirational. And I hope that everyone who has been here today got some inspiration, some information, some ideas. Sometimes the next big break in your business is just from hearing a question that you've never thought of, or looking at something differently in your business. So we really hope you found that here today. I really want to thank Deanna Hamilton and Sam Sugarman for being here as our experts. I also want to thank Fifth Third Bank for being our partner here and supporting the small business community. And I want to thank all of you for taking some time out of your busy day. I know entrepreneurship is always busy, and taking this time to commit to your business. We hope it was helpful, and we hope that you feel ready to grow and find more success in your business towards the end of this year. Have a wonderful day. Thank you, everyone.